The CME Fed Watch was projecting the Fed funds rate to decline to potentially by 200 basis points by next July. That implies lower inflation. Is the market right?
Well, the market is darn confident. It's just because the Fed's cutting interest rates doesn't necessarily mean that inflation will take back off. You might need an exogenous shock, like an oil shock, that filters its way into the economy and metastasizes and builds on itself. It's a very complicated outlook that doesn't necessarily fit into easy buckets.
Cameron Dawson, CIO of NewEdge Wealth, joins us once again. She's back to talk to us about the markets, the economy, the outlook for corporate earnings, and what's next for investors. Welcome back, Cameron.
Thank you so much for having me.
Cameron, a recent report will go over some of the key highlights, including the GDP revisions, jobs numbers, China stimulus. But let's start with the market. The S&P 500 hitting new all-time highs today and yesterday, and pretty much every single time I see you, Cameron. New all-time highs by the end of the year as well. Is that what you're expecting?
Well, don't fight the trend. The trend has just been so predominantly higher for this market, and this ability to continuously shake off any sense of doubt, any kind of volatility that continues to just resolve higher, even what has been a tougher seasonal stretch, typically going into an election and an open field election, there's uncertainty, and that typically has resulted in weaker markets in times like September through October. But this market continues to barrel higher. We think it really boils down to the fact that if you're going to run highly stimulative fiscal policies that help support growth at the same time as shifting to more easy and supportive monetary policies, given the Fed has already cut interest rates by 50 basis points and is talking, if you believe Austin Goolsbee, one of the Fed members, about hundreds of basis points of cuts. This combination of stimulative fiscal and stimulative monetary policy is something that risk assets typically love, meaning that you're getting the growth, but you're also getting the extra liquidity coming out of central banks. Now, that doesn't mean that we should be complacent. It doesn't mean that we should close our eyes and say that there's no risks here. We could go through the whole layer of risks of valuations being extended, positioning being extended, sentiment being extended, earnings estimates being extended, all areas where expectations are high. But until they're given a darn good reason to be proven otherwise, this market and the trend that is so dominant, we think does continue. So it does raise the potential for more all-time highs into the end of the year. Then, of course, we have to ask the question, what does that set up for 2025? And is there risk that we've pulled anything forward?
Okay, so you wrote in your report that it's not yet overbought the S&P 500, but momentum looks to have gone sideways. What do you mean by that? Are you making the projection that we're going to get sideways momentum?
Yeah, we've seen some of the momentum measures if we're looking at things like the MACD, if you're looking at RSIs, different technical indicators, as well as things like the percentage of names making new 20-day highs, that classic breadth thrust where you see all of the index using things like the Russell 3000 surge higher. That typically is followed by really strong forward returns when you see that kind of surge. And we haven't seen that over the last couple of weeks, over the last couple of months. And so it could just suggest that maybe it's not a straight up and to the right kind of market. But I think we should ask the question, do we really want that at this stage, at this valuation? There is a true clear and present danger of a melt up. And I say danger because a melt up is great when you're in the midst of it. Markets are moving significantly higher. There are a lot of gains to be had. Just even with the knowledge of knowing that you're in a melt up doesn't mean you shouldn't be invested, doesn't mean you shouldn't have exposure, but you have to appreciate that what comes on the other side of a melt up is a meltdown. So that idea of vigilance again comes back, meaning that we want to be very disciplined in what we're paying for different components of the market. We want to be disciplined about how much leverage we have exposure to, for example. So all of that is to say is that right now in the short term, we wouldn't be surprised to see more volatility only because of seasonality and some of this waning momentum. But again, the trend is still dominantly higher. And until proven otherwise, we think we have to respect that.
Before we continue with the interview, I want to tell you about another way you can invest your Bitcoins and store them safely instead of using a traditional wallet or an exchange. Consider an IRA. Today's sponsor, iTrust Capital, is one such IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1% only. And being an IRA, it also offers unique tax benefits. If you'd like to get started and learn more, click on itrust.capital/David in the link down below or scan the QR code up here. If you're over 18 and you want to open a new account with cash or roll over an existing account, you can do so using my referral link. And if you use that referral link, you'll get $100 in signing bonuses. Use the word stimulative when discussing monetary policy. Is it stimulative, though? Because let me show you this chart. This is the Fed balance sheet. It's been on a decline in terms of their total assets held ever since the beginning of 2022. There was a bear market in 2022. However, there was a subsequent bull market following 2022, 2023, and 2024 saw huge rallies, even though tapering continued. So I'm wondering if this trend is significant at all.
It's such a good point, and it raises the point about the offset from what Treasury is doing and there's been some fantastic work by the likes of people like Dan Clifton at Strategas and talking about effectively as Powell has drained liquidity. You've seen Yellen find ways in order to add liquidity, whether it's spending down the TGA or the mix of bills versus bonds and the funding of the large deficits that we've had, which I think the in conclusion argument is that the process of quantitative tightening has not been nearly as liquidity draining on net this time around. The process of quantitative tightening has not been a continuous headwind to markets because it hasn't drained liquidity on net, which has then allowed markets to soar higher, even with the fact that if you look at things like that, those broad liquidity measures that include the balance sheet, it doesn't necessarily suggest that we should be seeing the kind of strength in markets that we are. It's when you start adding in those treasury factors that you start seeing the fact that liquidity has actually been supportive of this market. And I think that also speaks to the fact that if you look at something like financial conditions in the broad sense, I think your point of questioning, is this stimulative or are we tight, is a really interesting one. Because if you listen to the Fed and you listen to Powell and Goolsbee, their argument for why they want to see swift interest rate cuts is not because the data is falling off a cliff. We just got GDP revisions last week that were revised higher for the last 3 years, significantly higher. You're still seeing resilient growth. But their argument is saying, look, real rates are so high, real rates meaning the nominal rate minus inflation. Real rates are so elevated that by definition, this is going to slow growth down. Now, what's interesting is that during this entire time that real rates have been positive, and they've only been positive since the summer of last year, that the entire time that we've been positive in real rates, we've actually been growing above trend. So it raises the question of the empirical evidence of why we need to cut so much if you're still seeing above trend growth with these real rates. The last point I'd say on that is if you look at financial conditions in a broader sense, so financial conditions that are like the Goldman Sachs Financial Conditions Index, the Bloomberg Financial Conditions Index, all things that you can look up, what you'll see is that paints a picture of that policy is actually in stimulative or easy territory right now, or financial conditions are in stimulative or easy territory, which just means that if you include things like equity valuations, credit spreads, the dollar, the level of interest rates, if you take a broader look, you're not necessarily in a state where financial conditions themselves are so tight that they're restricting growth. We've seen this in practice. So one anecdote is that we spend some time with a private credit manager who speak to these guys all the time because they're seeing all these shifting sands of what's going on in the economy. And they're talking about how their businesses are going to return to investing in the business because they're saving money on their interest rates because spreads are compressing. At the same time now, thanks to Powell, that base rate is compressing. So that's freeing up dollars for them to invest in their business. This is why broad financial conditions matter. This is why we consider them a good predictor of economic growth. So it's so interesting that we're embarking going on this easing cycle at a time when financial conditions are already easy.
Yes, fiscal dominance is one thing that I've heard over and over again. The idea that the Treasury has more impact on inflation than the Fed. Is that true right now?
Yeah, I think that that's a very good argument. I think it also needs another layer to it, which is that we have to appreciate the exogenous factors that cause the inflation ride up and then now ride down that didn't have much to do with the Fed, had a little bit more to do with the Treasury, meaning Treasury was funding the checks that were being given to people during the pandemic, which helped to fuel goods demand. But so much of the inflation, at least in durable goods prices, which eventually you saw in goods prices as well, that inflation, of course, was really the effect of the supply chain bullwhip of shutting down the economy, and that you're still actually seeing overhangs of that today, of that kind of echo effect in some of the data. So I think that it's easy for us to want to bucket to say, oh, all the inflation is always and everywhere a monetary phenomenon. It's just the Fed's fault, or all the inflation is just Treasury's fault, or all the inflation is pandemic and it's truly transitory and there's nothing to see here. It's a little bit of everything, and appreciating that I think is important as we think about how policy going forward will impact things like inflation, because you have to have this holistic sense. Just because the Fed's cutting interest rates doesn't necessarily mean that inflation will take back off. You might need an exogenous shock, like an oil shock, that filters its way into the economy and metastasizes and builds on itself. It's a very complicated outlook that doesn't necessarily fit into easy buckets.
The ghost of Milton Friedman is frowning at you, Cameron.
I know. I'm
Uh,
sorry. I'm sorry, dear sir.
but okay, since you brought up inflation, what is your outlook on inflation? The CME Fed Watch was projecting the Fed funds rate to decline to potentially by 200 basis points by next July. The distribution lies between 275 to 325 basis points. Now, that implies lower inflation. Is the market right?
Well, the market is darn confident. If you look at the inflation break evens, to your point, the market is projecting that you are going to get to that 10-year inflation break even is now at 2.2%, which is back to pre-pandemic levels. The 2-year inflation break even is actually below 2%, but that just tends to be correlated with oil prices. So the market has already fully priced in the success of the Fed, if we want to give them the credit for it, the success of the Fed in fighting inflation. And so it does raise eyebrows of saying, do I really want to believe if everybody also already agrees? We then take a step and we look at the components, the big buckets of inflation, and that's where, at least right now today, we're not necessarily seeing signs of a big reacceleration. If you look at things like rents are stable in their growth rate, about where we were pre-pandemic levels. You look at wages, leading indicators of wage growth, things like the JOLTS quits rate, which is actually a pretty helpful leading indicator of where the Atlanta Fed wage tracker goes by about 3 or 6 months. That continues to point to a moderation in wage growth. If you listen to companies, pricing power continues to be something that they say that they're losing. So this is not companies able to jack up prices, consumers kind of hitting a wall. So all of those sort of endogenous components of inflation stuff within the economy, all of that suggests that we don't have another big acceleration that is predestined. Then you have to consider these exogenous factors. How would an economy deal, the US economy deal with oil prices going to 100 or some kind of big commodity boom and cost inflation? What if we have exogenous factors like restrictions on immigration that significantly reduce the labor supply pool? A really fascinating point on that point to wrap up is that if you look at housing related employment, it's still at a cycle high. That's interesting because housing construction starts for multifamily as well as single family homes, starts as well as overall construction peaked between 1 and 2 years ago. So even though you're building fewer homes, you're still employing more people each and every year, each month as we get the data. Why is that? Because housing related employment has been so tight and remains tight. So imagine a scenario where mortgage rates continue to fall. And if mortgage rates continue to fall and you start to see even a bigger uptick in a recovery in housing related construction, all of a sudden you look around, you go, where do I get the people? And this is where you could paint a picture of a reacceleration in some things like wages in tight labor market scenarios, that as interest rates stimulate interest rate sensitive parts of the economy, you raise the question of, is there really a pool of ready, willing, and able workers in order to step in to satiate that demand? And I think that's a question for 25, and maybe it's a question more for 26, because these things do take time. But I wouldn't want to grow complacent about inflation, but at least in the next 3 months, we're not making some big reacceleration call.
How likely can we get deflation?
Well, you in pockets of the economy, you've been in deflation. If you look at the durable goods index in the PCE, what's fascinating about it is that it peaked at the beginning of 2021. And it actually went into outright deflation in 2022 and has been there ever since. So you've been in durable goods deflation for the last 2 years. Isn't it grand? And what's interesting about that is you've had stable and growing durable goods demand. That's your supply chain bullwhip effect. That's your kind of extraordinary scenario that gets resolved and prices start to come back to earth. So then it raises the question of, could you see outright deflation in the other big buckets? Outright deflation in goods prices, not so non-durable goods, consumable goods prices. A lot of that is oil. So you'd need to see oil prices fall on a year-over-year basis. And then the deflation from the services line, which a big chunk of that is rent. And we know that that significantly lags or housing related. We know things like OER are really imperfect measures that significantly lag what the real economy is experiencing. So you'd have to make a call for outright deflation, and including rent to be a big drag on that. And then you'd have to go into a weaker labor market environment, likely to get that wage growth to turn even lower, to filter into other pockets of the inflation bucket in services. So all this to say is a lot would have to happen for us to go into outright deflation, and we would see that as being something that would happen concomitant likely with a recession.
Here's the thing, and we'll talk about a recession in just a bit. This is the CPI index, or not the index, the inflation rate of the CPI, rather. We're currently at 2.5%. As you'll recall, in the decade following the 2008 financial crisis, that was a decade which saw the longest bull market in American stock market history. We had brief periods where the inflation rate fell to zero, if not in one particular month, negative 0.2%. So slight deflation on consumer prices. The markets not only did not hate that, but there was a continued bull market. There was no recession here. And if you recall, during this period, the Fed funds rate was near zero. So
Yeah.
what's different this time?
Well, I think what's significant about the period that you just highlighted, April of 2015, that
Mhm.
was the industrial recession.
Ah,
So you go back to 2015, and it's really interesting because it didn't impact the overall economy, but that is when oil prices started to plummet. So back in the summer of 2014, oil prices hit a high, I believe it was in July of 2014, and proceeded to fall. If you remember that fateful Thanksgiving day when OPEC said, oh no, we're not cutting production, we're raising production, effectively trying to play a big game of chicken with US shale producers, and saying that we're going to put you out of business because our break evens are so much lower than your break evens.
mhm.
They weren't betting on the great American might of innovation, where they got the break evens on shale production to be much lower. But over the course of 2014 until the low in 2016, oil prices fell precipitously from almost $150 a barrel down to about $30 a barrel. So a lot of the deflation that we had in 2015 was a result of falling
I
energy
see.
prices. And what's interesting about that, though, is that that wasn't a victimless crime, because you saw huge amounts of pain within the oil complex. You saw high yield spreads, I think, widen out to 900 basis points because a lot of high yield debt was energy related debt at that time. But you also saw the overall manufacturing complex within the US absolutely grind to a halt because they had built up around this fracking boom. So we were on the precipice of recession, and the only reason I was close to it at the time, I was covering industrials, and I remember screaming out saying, "Guys, something's really wrong here. This is not good." My companies were telling doomsday stories. So it's a great example of a mid-cycle slowdown, and the Fed responded. So the Fed had raised rates once in December of 2015, despite everything I said, all that pain. And it was in February of 2016, Yellen was set to raise rates three more times over the course of the year, is what they put in the dot plot, and it all got reversed out. They took it all out, and to that day, what you saw was oil bottomed, industrial stocks bottomed, the dollar peaked. You saw interest rates reverse directions. All of these things changed direction all at once because of that pivot from the Fed, and the Fed responding to the fact that that there were big pockets of the economy that were in a world of pain.
Moving on to economic growth, we know that conventional thinking would tell us that a Fed cut or easing monetary policy would be stimulative, like you said, and induce risk on behavior. Could you imagine a scenario in which a declining Fed funds rate would actually create or induce a recession?
Hmm. It's such an interesting thought experiment. I really enjoy this one because it speaks to acknowledging the difference in the balance sheet today in the economy versus any of the prior cycles we've had in the last 40 years. And the rationale or the reasoning behind that is appreciating that after over a decade and a half of unprecedented support and pressure down on the long end of the yield curve, that through quantitative easing, that of course reached its peak in 2020 when the 10-year Treasury hit 0.5%. This allowed for an unprecedented terming out of balance sheets. We saw average maturities of bond indices blow out, it would get much longer. You saw the usage of things like commercial paper fall. You saw the usage of floating rate mortgages fall because people were locking in these historically, not just over the last 40 years, but over the last 400 years, historically very low rates. And so, to your question about whether or not rate cuts could actually be restrictive, this is the scenario where that plays out, which is that you appreciate that rate hikes, sorry, have not been as restrictive this time around. Because if you look at things like net interest expense on a corporate basis in aggregate, last year it fell. It fell for the first time in a hiking cycle ever. It fell 35%, which means that in aggregate, companies were earning more on their cash than they were having to pay more in interest. So they were getting the benefit that the Fed was raising rates, but they weren't feeling the restriction from those higher rates. Again, this is an aggregate, not to say all companies benefited from higher rates or all households did. So then the question from here, of course, is that if you're not seeing the benefit from, or you didn't feel the pain from the lower rates, but got a benefit from higher rates, does the reverse happen? Meaning when the Fed cuts rates, all of a sudden people are earning less cash on their money that's just sitting around, or less interest on their cash that's just sitting around. Do you see companies or consumers who've been really enjoying these high yields start to pull back on spending some? I don't know if it's enough in aggregate to halt the economic cycle, but I think it is a serious consideration, which is just appreciating that the top 20% of consumers have the highest cash balances. No surprise, top 20% income owners, but they also make up 40% of overall spending. So if you start restricting some of that income that they're receiving on their cash balances, in theory, could you see them spend less? Yeah, you could. I don't know if it's enough to tip us into a recession, but it's certainly enough to kind of say, hey, this time it actually is a little bit different because of the makeup of balance sheets.
Okay, what would the next recession look like? Would it be consumer driven or would it be a supply shock driven recession?
If I had to be a betting person, we've talked about it quite a bit, is that the one area where you think that where I think there could be pain and recession, and maybe it doesn't happen because the Fed is cutting, is in small businesses, because small businesses have the most usage of floating rate debt. They felt the pain the most from higher interest rates. They also are the biggest employer in the US, and they've been doing this labor hoarding. And if you want to so you get a good argument as to why the Fed started cutting rates. And this is from Anna Wong at Bloomberg, who's been flagging this in a really brilliant fashion, just saying, hey, Powell really looks at the beige book. The beige book is a lot of anecdotal evidence about what's going on in the economy, inclusive of a lot of small businesses. And small businesses are feeling the pain from higher rates. And the risk would be is that if you keep rates high, then they're going to start turning not just to slower hiring, which is what they've done, but increased firing. And if that happens, that's when you get your recession, and you'll be too late because it's going to be a self-reinforcing mechanism, and you'll see this pain in the economy that could have been averted by just easing up on some of the cost of debt. So I do think that the consumer, if you look in aggregate, looks really strong. Assets have been growing faster than liabilities for the last 10 years, really since the great financial crisis. It's very different than pre-pandemic, or sorry, pre-great financial crisis, which is where liabilities grew faster than assets. That's why a consumer balance sheet recession. But the problem with looking at the consumer is that in aggregate, it looks a heck of a lot better than if you start splitting it apart. And as you start looking at the bottom two income cohorts, so effectively the bottom 40% of income owners in the US, that's where the pain is truly real. They've borne the brunt of the most of inflation, meaning that the majority of their consumption has experienced the highest amount of inflation. They have less savings, less exposure to equity markets or housing markets that have done really well. They have more likelihood to have revolving credit, not fixed rate credit. So as interest rates have risen, they've gotten a greater pinch. The challenge is they make up a smaller portion of overall consumption in the US. So their pain, the very real, very felt, hasn't been enough to pull down overall economic growth. But to the point is that we all breathe the same economic air. At some point, is there a challenge that these bottom two income quintiles could cause greater weakness within the US economy? It is a possibility, but possibly one that can be averted given lower rates. Possibly.
Let's take a look at what the markets are feeling right now in terms of sector outperformance here. Take a look at my screen. I have here a chart showing the IYC, Consumer Discretionary ETF. Discretionaries have done okay if you compare this to the SPS, XPX rather. On a year-to-date basis, the XPX has outperformed discretionary. On a 3-month basis, we're starting to see some sector outperformance. If you take a look at staples, so I think staples would be here. Consumer staples. The XLP, let's just take the XLP as an example. The XLP has greatly outperformed the SPX over the last 3 months. I'm looking at a 3-month interval. Yeah. If you take a look at something like utilities, for example, that is let's just do,
I think you do XLU.
yeah, XLU is fine. That has also shown a similar story. Why is it that people have been rotating into defensive sectors during a rate cut? And by the way, this was like a rate cut was already premeditated by July, and
Yep.
yet capital flowed into defensives all throughout the summer into now, basically. Why?
Well, I think that last point is probably the most important one, which is that if you look, and Jeff DeGraff at Renmac has done some great work about this, is that post the first cut, you have typically seen defensives outperform. Now, name your narrative as to why that is. Everything from the fact that oftentimes the Fed is cutting for a darn good reason, and so growth is falling, and so you see
Hmm.
defensive outperformance. Maybe it's because these names tend to pay higher dividends, and so they're seen as bond proxies. So as yields are falling, they become more attractive, and so those are usually the two big narrative buckets. But I think that your last point about it being starting to be priced in July is the most interesting one, because what happened in July? July was the first point where a September rate cut went above 100%, meaning that in July, markets said with absolute certainty we're getting at least one rate cut. And we actually think we might get a supersized one. And ever since that point, the market has been trading as if the rate cuts had already started. So defensives outperform, cyclicals underperformed, including things like semiconductors, which are one of the biggest weights within the cyclical index.
Hmm.
So it just suggests that the market is following a very classical pattern post the first rate cut. It just got to it early because we were pricing in over 100% probability. I think the question is how much of this defensiveness is a reflection of growth fears? And should we see it as a sign that the market is afraid of growth going forward? Typically, we will look at things like transports versus utilities as a classical intermarket signal that the market is getting scared about growth if transports are underperforming utilities. One of my other favorite ratios is equal weight discretionary versus staples. So discretionary outperforming staples on an equal weight basis. You do that to remove the outsized weighting from Amazon, Tesla within the discretionary sector. But if discretionary is outperforming staples, it's a sign of rising growth prospects and a strong outlook. If staples are outperforming discretionary, as they did over the course of 2022, we typically are seeing cuts to growth forecasts on down when we look at household consumption forecasts and GDP. So all of this is to say is when the market speaks, we should listen, but it's hard sometimes to interpret it, mostly in this backdrop as well. One last point on utilities, because utilities, we coined the term 2 weeks ago, euphoria, that the euphoria around AI has shifted from just the semiconductors now to utilities, where you had seen significant outflows earlier in the year. Valuations were not stretched, but now you've seen that shift where you've seen huge inflows into utilities to kind of euphoria territories as people have chased this kind of narrative about needing to build out the infrastructure in order to support AI. That's where having a very keen eye towards valuation discipline will be important, because it's not to say that they can't keep going up. But if you start pricing in, you similar to what happened in the late 90s, where you price in way too much growth in like this physical infrastructure, typically it ends poorly. But for now, the trend is up. It's one of the best trends in the market, so you can't fight it.
Okay, we'll finish off on your sector biases just a bit, but going back to the jobs market, I don't have data to prove this. I'm just getting anecdotal kind of reports from people that I know, especially in the tech sector. They're kind of worried about layoffs right now. To your point about Anna Wong from Bloomberg, they're projecting higher unemployment above 5% by next year. Take a look at this chart here. This is U.S. corporates, cash on hand, and in U.S. banks. It's been declining ever since 2021.
Mhm.
Now, obviously still higher than pre-pandemic levels. However, this trend is downward. What is this signal? Are they spending cash because they're, in a high capex cycle and this is good for growth, or are they spending cash because they need to deplete it,
Yeah,
which
it's a good
which may lead to layoff? Yeah.
Yeah, it's a great question. And it's a fantastic chart, because what it points to is that sort of there's a corollary to what's gone on with consumers with really big cash balances that have been spent down. And if you think about the last 3 years of really resilient growth, one of the reasons why companies and consumers have been able to shake off all of these stresses is simply because you've had this buffer from the higher cash balances that have allowed you to absorb a lot more shocks. It's sort of like a shock protector. And so as that gets whittled down, I think your question about what that means for layoffs is a really important one, because one of our calls for next year is that, or one of our key risks for next year is we see risk that corporate profits on a 12-month forward basis start to level off. If I showed you the corporate
Mm.
profit chart on the next 12-month EPS forecast, what you see is that ever since 2022 into 2022, it's been rising significantly. And that straight line higher in EPS on a 12-month forward has been what has supported this market. It's been why this market is so strong. But if that profit growth starts to level off, and what's the reason it would level off? Well, margin forecasts are really high. Nominal growth might be decelerating. Remember, real growth plus inflation decelerating. That would suggest that maybe the pace of growth does start to level off. And that's when companies who have been effectively labor hoarding might have to think twice about how many people that they have on their books for employment. And that's your classic kind of income cycle. And what will we watch in order to determine that? There's two key stats that I'd keep a really close eye on. The first stat is the NFIB's small business jobs being hard to fill. This is one of the few labor statistics that's actually still above the pre-pandemic levels. Small businesses are still saying that they're having trouble filling open jobs. This is a reflection of the fact of the scars that happened in 2020 and 2021, the fact that companies are really you still had that trouble or that overhang from not being able to fill jobs. So watch that closely. If that deteriorates, that's your sign that companies are really going to start considering firing versus just what's happening now, which is slower hiring. And so the last one to watch is that there's a strong relationship, or has been at least, between the what's called the labor market differential. That's the Conference Board's consumer confidence index that looks at the jobs being plentiful versus hard to get. The difference between those two is called the labor market differential. And that labor market differential has led the unemployment rate consistently every single cycle in the last 40 years. So when consumers start reporting that they're not able to find jobs, it usually is the gateway to a higher unemployment rate. And they haven't been wrong. And one of the things, we got an update of this last week, is that consumers continue to say, we're having trouble finding jobs. And so the challenge is, will that trouble finding jobs actually morph into firing? If it does, that is your recession indicator. If we're just in this world where we have a slower hiring pace and that people do make do with what they have, it suggests more of a muddle through of growth. And then, of course, if hiring starts to pick back up, that's your reacceleration scenario. So those two things, Conference Board, labor market differential, as well as the NFIB small business jobs being hard to fill, are some of the most important watch indicators over the next few months.
And then final point on global economics, China stimulus package recently announced, and you wrote about this in your recent piece. You commented about China going back to the future. What are they going back to exactly?
Yeah, so the idea being is that China has a long history of providing stimulus to its economy and its markets responding in a really resounding way. 2008, of course, in the midst of the great financial crisis, big one in 2015, into the beginning of 2016. Remember, I talked about that industrial recession that was in large part due to the industrial weakness within China, where they had huge stimulus and roaring markets coming out of that. Then, of course, you had stimulus in 2020, all times where China responded to economic woes, oftentimes post some kind of restructuring, post some kind of corruption crackdown, and then stimulating on the other side of it. And markets loved it. And the difference is, so we put in the piece quote, roads, where we're going, we don't need roads. And the reference to there is that in some ways, this is not about roads. This is very different than the '08 stimulus, which was very commodity heavy, very old economy heavy. You look down the list, and yes, there's housing stimulus, which will have a commodity kind of old economy aspect to it. But there's also just giving checks to consumers in need and supporting the purchase of stocks, which has sort of more of a new economy aspect to it. So the message that we're saying about China is one where These rallies post stimulus have the potential to blow everybody's expectations out of the water. We've seen it so many times. But you have to know that you're here for a good time, not necessarily a long time, because what we've seen on the other side is big collapses in stock prices, and that there is a very speculative nature to a lot of the Chinese markets where you see this chase effect that causes you to see upside happen a lot swifter, a lot faster than expected. But Walter Deemer, who is one of the greatest technical analysts of all time, has a fantastic quote in his book, when it comes time to buy, you won't want to. He says, when stocks go up in a straight line and parabolic, they typically can go a lot longer and a lot further than you think they can, but they don't correct by going sideways, they correct by going straight down. So our view is that this doesn't necessarily change the medium to long-term challenge that the Chinese markets have, but that medium to long-term doesn't mean that you shouldn't participate today. You just have to go in knowing that this could be a very short-term engagement.
We're going to close off on asset allocation and your preferences. I'm going to follow a social media trend and we're going to play a game called Would You Rather. So, emerging markets or domestic equities, which one would you rather right now?
Over what time period?
Let's do 1 year. Let's just stick with 1 year for this exercise.
I think EM has the potential to outperform over the next year,
Mm.
but I would not do it as a long-term buy and hold.
Okay. Emerging markets over US semiconductors.
Oh, that's a tough one. Um, from a valuation perspective, there's just more room to run in EM that can chase. But again, if I'm buying something for more than 12 months, I'd buy semiconductors all day long.
Semiconductors in the next 12 months versus 10-year treasury.
Semis. Yeah.
Interesting. Okay. Wait, on that note, so you don't think yields are going down?
I think that there is, in the short term, the potential that they rise because economic surprises have turned positive. Just meaning that when you see economic surprises trend higher, it has typically been associated with higher yields. If you also consider the fact that there's some wild cards post-election with fiscal from both parties, I don't know how the bond market is thinking or potentially digesting what a sweep in either direction could look like. But deficits we do know are high. Yields have not been falling because of some miraculous fix of the deficits. They usually become an issue when they are an issue, which just means predicting the timing of it. But I wouldn't want to be too complacent on yields, just given the fact that bets as well for yields to continue to fall have risen materially. So we see, at least in the very short term, the potential for yields to rise, given
Okay.
that backdrop.
Very interesting. Large cap semis versus the Russell 2000.
At least Russell 2 for a couple of months. Again, if I'm a long-term owner, I'd rather own semis all day long. I'd rather own great businesses. But if you're talking about a trade, and you're talking about where valuations and starting points are, that last shall be first dynamic, I think, is a pretty strong one right now, which is why EM, small cap, value might have their day for a time.
Okay. And then final question, how would, just generally speaking, how would this change if we made it 5 years?
Well, the 5 year is going to look much higher quality. I think you'd want to keep your EM exposure, as we look in our allocations, we keep it pretty tight because over the last 15 years, EM has been terrible. It's been a really poor risk adjusted asset. Same as well as for small caps, meaning that they've added volatility to portfolios, but not alpha. And that doesn't mean that that can't change. And I think the biggest question for people in my seat is the degree of stimulus that has happened out of China enough to change that trajectory where you've had so much underperformance for, it's actually more than 15 years. It's nearly 20 years now. Since the peak in 2007. So there will come a time where you will have probably a multi-year bull market in these unloved areas that do warrant you not, you not being way overweight US large cap growth, which has been having its own bull market for the last 15 years. But we've seen a lot of false dawns, a lot of head fake rallies. So I think having some discipline and staying in the higher quality echelon of things, I think is important, mostly for investors that have a longer time frame.
Okay, very good. Thank you very much for a very comprehensive interview today. Cameron, where can we learn more about you, read your work?
Wonderful. You can go to newedgewealth.com. You can sign up for the distribution list there. We publish every Saturday and Monday charts, as well as I'm on X at Cameron Dawson. I'm also on LinkedIn where I post a lot of things as well. So you can find me anywhere and everywhere.
We'll put those links to everywhere and anywhere to Cameron. Thank you very much. Yeah, and the Monday charts, I get them. They're great. So I recommend people check that out.
Awesome.
Appreciate it, Cameron. Speak next time.
Thank you so much.
And thank you for watching. Don't forget to like and subscribe.